Income or capital gain, the test for capital gain. With the Income Tax Act not providing a definition of a capital gain, but only setting out the technical computations to be made once it has been determined whether a transaction is an income receipt or a capital receipt, it has fallen upon the courts to provide their guidance as to what constitutes a capital gain. Yet here too there is a certain degree of difficulty, as the courts have not provided absolutes as to what constitutes a capital gain as opposed to income, such that there is no clear certainty as to the assessment and treatment by the Canada Revenue Agency, creating ongoing challenges for taxpayers and the professional advisors. Nevertheless, there are some core guidelines from the courts as to what constitutes a capital gain, with the federal court's decision in Happy Valley Farms Ltd. versus the Queen having served as the framework test for ascertaining income versus capital gain for some 4 decades. The framework test begins with the assessment of the specific facts against 6 questions, yet proceeds further with greater analysis of the taxpayer's intention and motivation to determine whether the gain realized on the disposition of property is an income gain or a capital gain. As you will note, the court's test is not clear-cut, instead presented as legalistic interpretations of the specific facts, such that every situation demands its own factual analysis and legal interpretation. And for that very reason, we lay out the court's own words, as opposed to providing a more concise explanation, which the court made legally impossible. What the court sought to ascertain is whether the taxpayer had acquired the property as an investment or not, such that it was held for purposes of a trade or business or, quote, an adventure or concern in the nature of trade, end quote, such that it constitutes an income gain, as opposed to an investment where the facts support a determination as a capital gain. 1. The nature of the property sold. Although virtually any form of property may be acquired to be dealt in, those forms of property such as manufactured articles, which are generally the subject of trading only, are rarely the subject of investment. Property which does not yield to its owner an income or personal enjoyment simply by virtue of its ownership is more likely to have been acquired for the purpose of sale than property that does. 2. The length of period of ownership. Generally, property meant to be dealt in is realized within a short time after acquisition. Nevertheless, there are many exceptions to this general rule. 3. The frequency or number of other similar transactions by the taxpayer. If the same sort of property has been sold in succession over a period of years, or there are several sales at about the same date, a presumption arises that there has been dealing in respect of the property. 4. Work expended on or in connection with the property realized. If effort is put into bringing the property into more marketable condition during the ownership of the taxpayer, or if special efforts are made to find or attract purchasers, such as the opening of an office or advertising, there is some evidence of dealing in the property. 5. The circumstances that were responsible for the sale of the property. There may exist some explanation, such as a sudden emergency or an opportunity calling for ready money, that will preclude a finding that the plan of dealing in the property was what caused the original purchase. 6. Motive. The motive of the taxpayer is never irrelevant in any of these cases. The intention at the time of acquiring an asset, as inferred from surrounding circumstances and direct evidence, is one of the most important elements in determining whether a gain is of a capital or income nature. From there, the federal court continued with its analysis, stating that while all of the above factors have been considered by the courts, it is the last one, the question of motive or intention, which has been most developed. That, in addition to consideration of the taxpayer's whole course of conduct, while in possession of the asset is what in the end generally influences the finding of the court. This test has been carried one step further by Canadian courts into what has generally been referred to as the secondary intention test. This has meant in some cases that even where it could be established that a taxpayer's main intention was investment, a gain on the sale of the asset would be held taxable as income if the court believed that at the time of acquisition, the taxpayer had in mind the possibility of selling the asset if his investment project did not, for whatever reason, materialize. This in turn provided the basis for the federal court finding that the particular facts in Happy Valley Farms Ltd. versus the Queen were in the form of income as opposed to capital gain, concluding as follows. Upon examination of all the circumstances surrounding the transaction under review, including the nature of the subject property, and in particular the virtually non-existent likelihood of the land producing income without being sold, the conduct of the plaintiff company while it owned the property, especially the number of similar transactions before and after the transaction under review, and the minimal farming activity engaged in by Mr. Lindholm, I can come to no other conclusion than that reached by the Tax Review Board. The land was acquired by the plaintiff as a revenue-producing investment to be disposed of at the best opportunity. The motivating reason for the acquisition by the plaintiff of Field Farm was the expectation that it could be sold for profit. The transaction under review was, in my opinion, part of the ordinary business of the plaintiff in developing real estate for resale. The profits from the sale of the subject property were profits from the business of the plaintiff and were properly included in the plaintiff's income by the Minister of National Revenue. Recognizing that the taxpayer's preferred tax treatment would be as a capital gain, it is crucial to understand how the Canada Revenue Agency will argue for tax treatment as income, where it denies recognition as a capital receipt. Should you be seeking legal advice with respect to tax planning or other tax and corporate matters, contact our office for an initial confidential consultation. Thank you.